Did you know that by the time Warren Buffett turned 30, he had already made his first million? While most people are searching for shortcuts and quick wins in the world of wealth, Buffett's approach couldn't be more different. It's not about gambling on the next big trend or hoping for a lucky break. It's about following principles that stand the test of time. But how exactly does he do it? How does he turn his investments into such a massive empire? And more importantly, how can you apply these principles to grow your wealth in the years to come? In this video, we'll reveal the secrets that have made Buffett one of the most successful investors of all time, and how you can take those same principles to build your financial future in 2025. Think about this. While millions of people scramble to jump on the latest stock market trend, Warren Buffett and others like him are quietly doing something completely different, something that doesn't rely on getting lucky. They're following proven strategies that have stood the test of time, even through market downturns and times of uncertainty. Today, we'll walk through the 10 key investment strategies that have made Warren Buffett one of the richest individuals in the world, and how you can apply these principles to your own financial journey. But why listen to me? Well, over the years, I've studied how the world's wealthiest investors think. I've spent countless hours breaking down their strategies and learning from their successes and failures. And I can tell you one thing for sure. The best investors are not the ones chasing after the hottest new trend. They're the ones who know how to identify opportunities that will flourish for the long term. Whether you're a newcomer to investing or you've been in the game for a while, the insights I'm about to share will revolutionize how you approach wealth building. As Brian Tracy, one of the foremost experts in personal finance, often says, the key to financial freedom is mastering the basics. And that's exactly what we're going to do today: simplify Warren Buffett's strategies, break them down into actionable steps, and show you how you can begin using them today, no matter where you are in your financial journey. By the end of this video, you'll have a clear understanding of Buffett's timeless strategies, and you'll be armed with the tools and knowledge to apply these secrets to grow your own wealth, even in uncertain times like the ones we're facing in 2025. So stick around, because what you're about to hear could change the way you think about money forever. Are you interested in this topic? If so, drop a comment below with the phrase, "I will be the first trillionaire in my family." Once I see your comment, I'll make sure to give it a heart. And if you'd like to support the channel, leave a like and subscribe. It only takes a second and helps our community grow. We've got plenty more inspiring content coming your way, packed with tips to help you live a more successful and fulfilling life. Secret number 1: invest for the long term. One of the most powerful lessons we can learn from Warren Buffett is his unwavering commitment to long-term investing. He often says, "Our favorite holding period is forever." This simple yet profound statement holds the key to Buffett's success. While many investors chase short-term gains, Buffett is known for buying businesses that he can hold for the long haul, sometimes for decades. Buffett's philosophy is built on the idea that the stock market is designed to transfer wealth from the impatient to the patient. Short-term gains may seem appealing, but the true wealth lies in compounding over the years. When you invest for the long term, you allow the business to grow, its value to increase, and the dividends to accumulate, creating a powerful snowball effect. Patience is not about ignoring the market, but rather about understanding it. When you have a long-term vision, the day-to-day fluctuations of the market become less daunting. You are focused on the big picture, the health and growth of the business you own, not on the noise of daily price movements. Buffett himself has demonstrated this time and time again. The market will experience volatility, but over the long term, well-managed businesses with strong fundamentals tend to thrive. So, how can you apply this to your investing journey? Start by identifying companies with strong fundamentals, businesses that generate consistent earnings, have a competitive edge, and possess strong leadership. Buffett doesn't invest in companies based on speculation or trends. He focuses on businesses he believes will perform well over the long term, regardless of short-term market fluctuations. When you find a company that meets these criteria, don't rush to sell when the market dips. Instead, focus on the company's underlying business strength. Hold your position and let your investment grow with the business. Remember, investing for the long term doesn't mean buying and forgetting. It means staying involved, monitoring the company's performance, and sticking with your plan as long as the fundamentals remain strong. One of the best examples of Buffett's long-term approach is his investment in Coca-Cola. In 1988, Buffett's Berkshire Hathaway acquired a large stake in the beverage giant for about $1 billion. At the time, Coca-Cola was a dominant global brand, but its stock price had fallen from its highs. Buffett saw an opportunity in the company's brand strength, its extensive distribution network, and its ability to generate strong cash flow. At first glance, it may have seemed like a risky move, buying a stock that had struggled in the short term. However, Buffett understood that Coca-Cola's brand was a long-term asset, and that over time, it would continue to generate value. Fast forward several decades, and this investment has been one of the most successful in Berkshire Hathaway's history, returning many times its original value. The power of Coca-Cola's brand, its loyal customer base, and its consistent earnings paid off over the long run. Buffett has held his Coca-Cola stock for over 30 years, earning regular dividends and significant appreciation in value. He once remarked, "Our Coca-Cola investment has made us billions, and it continues to pay off." This is a textbook example of how patience and a long-term investment mindset can turn a solid opportunity into an extraordinary outcome. In summary, the key takeaway here is that short-term market fluctuations should not influence your investment decisions if the business remains strong. Invest for the long term, be patient, and allow compounding to work its magic. When you focus on businesses with a proven track record and growth potential, you align yourself with the strategies that have made Warren Buffett one of the wealthiest individuals in the world. Secret number 2. Understand what you're investing in. Buffett has made it clear that one of his golden rules is to never invest in a business unless you truly understand it. He calls this concept circle of competence, meaning that you should only invest in industries or businesses where you have knowledge and expertise. When you understand a company's business model, how it makes money, and the risks it faces, you can make more informed decisions about whether to invest in it. Without that understanding, it's like stepping into the dark, investing based on speculation rather than knowledge. Buffett's philosophy is simple. Invest in businesses that you can easily understand and predict their future performance. To apply this in your own investment journey, start with industries that you are familiar with. If you work in technology, for instance, investing in tech companies might feel more natural than investing in a complex financial institution. However, as you gain more experience and learn more about various sectors, you can gradually expand your circle of competence. Keep educating yourself, stay informed, and never stop learning about the companies or industries in which you invest. A great example of Buffett sticking to businesses he understood is his investment in See's Candies, which he acquired in 1972 for $25 million. While others might have viewed it as just a candy company, Buffett understood that See's was a unique business model with strong brand loyalty and high profit margins. Over time, this investment has turned out to be a fantastic one for Berkshire Hathaway. See's is a simple, understandable business. It sells candy to a loyal customer base, and the business model is stable and predictable. Buffett saw the value in businesses like See's Candies because he understood that the brand could grow and continue to generate consistent earnings. And he was right. See's Candies is a key example of Buffett's rule: invest in businesses you understand. By focusing on simple, easy-to-understand companies, Buffett has achieved long-term success without needing to dive into complex, unfamiliar industries. Secret number 3. Live below your means. Warren Buffett is widely known for his frugality, despite his immense wealth. One of the key lessons he teaches is that it's not about how much money you make, but how much you keep. While most people focus on increasing their income, Buffett emphasizes the importance of controlling your spending and living below your means. The idea is simple. No matter how much you earn, if you live beyond your means, it will be difficult to build and sustain wealth. On the other hand, if you save and invest a portion of your income, regardless of how much that is, you're setting yourself up for long-term financial success. Buffett's frugal lifestyle serves as a great example of this philosophy in action. It's not just about avoiding luxury purchases or extravagant spending. It's about making thoughtful decisions about your lifestyle, recognizing that wealth building happens over time. Buffett has always been careful with his personal finances, even though he could afford nearly anything he wanted. He drives a modest car, enjoys a relatively simple lifestyle, and still lives in the same house he bought in Omaha, Nebraska, in 1958 for $31,500. For Buffett, wealth isn't about acquiring flashy things. It's about building a foundation that allows for long-term growth. His ability to live frugally and save money has allowed him to accumulate significant wealth over time, which he's then able to invest and grow further. To apply this to your own financial journey, it's important to focus on saving and investing a portion of your income, even if you're just starting out. This doesn't mean you have to completely cut out all pleasures, but rather, it's about prioritizing your financial goals over short-term indulgences. You don't need to be wealthy to start saving. What matters is consistency. No matter where you're in life, start by keeping your expenses low and setting aside money for the future. The more you save, the more you can invest, and over time, you'll be amazed at the wealth-building power of small, consistent contributions. A perfect example of Buffett's frugality is his lifestyle. Despite being one of the richest people in the world, he still lives in the same modest house he bought decades ago. He could easily afford a mansion, but instead, he's chosen to live in a simple, unpretentious home. This decision reflects his values. Buffett is focused on the long-term growth of his wealth, not on showcasing his status through material possessions. In summary, the key takeaway is that you don't need to live a lavish lifestyle to build wealth. It's about making smart, long-term decisions, saving a portion of your income, and investing that money wisely. Warren Buffett's frugality is a reminder that building wealth is less about earning a huge paycheck and more about living within your means and making your money work for you. Secret number 4. Focus on value, not price. Warren Buffett's investment strategy has always emphasized the importance of value over price. One of his most famous quotes is, "Price is what you pay, value is what you get." This simple yet powerful idea has guided his investment decisions for decades. While most investors focus on short-term price fluctuations, Buffett looks beyond the market price and evaluates the intrinsic value of a company, what it's truly worth based on its fundamentals and long-term prospects. Price can be misleading. A stock's market price can go up and down based on various external factors, including market sentiment, rumors, or even macroeconomic conditions. But the true value of a company is determined by its ability to generate profits over time, the quality of its management, and its competitive advantage in the market. Buffett teaches that it's more important to assess a company's long-term value rather than react to the noise of daily price movements. To apply this in your own investing journey, you should look for undervalued companies, businesses that are trading for less than their intrinsic value. These companies may not be in the headlines or part of the latest trends, but they possess solid fundamentals and the potential to grow significantly over time. By focusing on value, you increase your chances of making smart investments that will pay off in the long run. A great example of Buffett's commitment to focusing on value over price is his investment in Geico. In the 1970s, Buffett's company, Berkshire Hathaway, purchased a large stake in Geico, a car insurance company. At the time, Geico's stock price was low, and many investors saw it as an underperforming company. However, Buffett saw something different. He recognized that Geico had a business model with strong growth potential and that its low price was an opportunity to buy a solid company at a discount. Buffett understood that Geico's direct-to-consumer model allowed it to operate more efficiently than traditional insurance companies, which relied on brokers. He also saw the company's potential to scale and expand its market share. Instead of being concerned with the stock price at the time, Buffett focused on Geico's long-term value. This decision paid off massively. Over the years, Geico became one of the largest and most successful insurance companies in the United States, and Buffett's investment has grown many times over. The key takeaway here is that successful investing isn't about chasing the latest price movements or trends. It's about looking for businesses that are undervalued relative to their true potential. By focusing on value rather than price, you'll be in a better position to make investments that yield substantial long-term returns. In summary, Warren Buffett's investment strategy teaches us to prioritize value over price. Don't get caught up in the day-to-day fluctuations of the stock market. Instead, take the time to evaluate the intrinsic value of a business, its ability to generate profit and grow over time. When you focus on value, you'll be better equipped to make sound investment decisions that pay off in the long run. Secret number 5. Diversification isn't everything. Warren Buffett has always taken a somewhat unconventional approach to diversification. While many investors believe that spreading investments across a wide range of assets is the key to reducing risk, Buffett doesn't over-diversify. Instead, he focuses on high-quality investments that he believes in deeply. Buffett's philosophy is that diversification is a strategy for those who don't truly understand investing. He famously said, "Diversification is for those who don't understand investing. I concentrate on my best ideas." For Buffett, the key to success lies in putting a larger portion of your capital into the investments you have the highest conviction in, rather than spreading yourself thin with many smaller, less meaningful positions. The idea is not to take unnecessary risks by over-concentrating in a single stock, but rather to carefully select a few high-quality opportunities that align with your strengths and knowledge. Buffett believes that if you understand a business well and have confidence in its future, there's no need to diversify into dozens or hundreds of stocks just for the sake of spreading risk. In fact, over-diversifying can dilute your returns. If you spread your investments too thin, it becomes difficult to monitor each one closely, and your portfolio's performance can be dragged down by underperforming assets. Buffett's strategy is to focus on his best ideas, companies he understands, trusts, and believes will deliver solid returns over time. A great example of this is Buffett's investment in Apple. For years, Apple had been considered a technology company that Buffett, known for his preference for traditional industries, wasn't interested in. However, when he fully understood the company's brand strength, its ecosystem of devices and services, and its ability to generate massive cash flow, he decided to make a significant investment. Instead of investing in dozens of tech stocks or diversifying into sectors that were unfamiliar to him, Buffett concentrated his investments on Apple. This decision has proven to be one of the most profitable moves in his career. Apple's stock price has skyrocketed over the years, making Buffett's investment worth tens of billions of dollars. By focusing on his best idea, Apple, Buffett was able to achieve extraordinary returns without needing to spread his investments across countless other companies. The key takeaway here is that diversification is not necessarily the secret to success. Rather than spreading yourself thin by investing in many different companies, focus on your best opportunities, the ones you believe will bring the highest returns and match your expertise. When you do so, you give yourself the best chance to generate wealth over the long term. In summary, Buffett teaches us that diversification isn't everything. While it can help mitigate risk, it can also limit your potential for significant returns. By concentrating your investments on your highest conviction ideas, you can achieve greater success and more effectively manage your portfolio. Remember, the goal is not to have a wide range of investments. but to invest in a few high-quality businesses you understand and trust. Secret number 6. Be greedy when others are fearful. One of Warren Buffett's most famous and widely quoted pieces of advice is, "Be fearful when others are greedy, and greedy when others are fearful." This quote speaks to Buffett's contrarian approach to investing. While most people panic during times of market downturns, Buffett sees these moments as opportunities to buy quality companies at a discount. The core of Buffett's philosophy is that fear often leads to irrational decisions in the market. When fear runs high, prices of stocks tend to drop, sometimes much lower than their actual value. This is when many investors sell off their positions in panic, creating a market opportunity for those with the patience and knowledge to take advantage of it. On the flip side, when the market is booming and everyone is overly optimistic, prices can become inflated, and this is the time to be cautious and conservative. Market downturns can often be the best times to invest, provided you can see beyond the short-term fear and assess the true value of the companies you're interested in. When everyone else is selling, that's when you should be buying quality businesses at a discount, businesses that have strong fundamentals and long-term growth potential, but are temporarily undervalued due to external factors or market hysteria. A prime example of this philosophy in action occurred during the 2008 financial crisis. While most investors were panicking and selling off their assets, Buffett was busy making deals. One of the most notable investments during that time was his purchase of a large stake in Goldman Sachs. At the height of the crisis, Goldman Sachs' stock price had plummeted, and many investors were uncertain about its future. But Buffett saw this as a chance to buy a quality company at a significant discount. Despite the widespread fear surrounding the banking industry and the global financial system, Buffett understood that Goldman Sachs had a strong business model, a long history of success, and a capable management team. Instead of following the crowd and selling, he bought shares in the company, later turning the investment into billions of dollars in profits. His ability to act when others were afraid is a testament to the power of this strategy. Buffett has repeatedly emphasized that the key to successful investing is not getting swept up in the emotional extremes of the market. When others are fearful, it's the perfect time to be greedy, because fear can cause people to undervalue strong companies, creating buying opportunities. When everyone is greedy, that's when you need to step back, evaluate, and make sure you're not overpaying for investments. In summary, Warren Buffett's "Be greedy when others are fearful" principle is a reminder to think long-term and maintain a calm, rational mindset during periods of market turmoil. Market downturns may seem intimidating, but they often present the best opportunities to buy high-quality stocks at a fraction of their true worth. By staying focused and resisting the emotional pull of market fear, you can use these moments to your advantage and build lasting wealth. Secret number 7. Use your emotions to your advantage. Investing is not just about understanding numbers and charts. It's about emotional control. Warren Buffett has always maintained that investing is more of a mental game than a financial one. The key to success in investing isn't just about picking the right stocks. It's about maintaining the right mindset, especially during times of market volatility. The stock market can trigger strong emotional reactions, fear when prices drop and greed when prices rise. But the most successful investors are the ones who can keep their emotions in check and stick to a disciplined, long-term strategy. Emotions like fear and greed often cause investors to make decisions that undermine their long-term success, whether it's panic selling during market downturns or overzealous buying when stocks are peaking. The ability to control these impulses is critical for staying on course and ensuring that your investments grow over time. Buffett's approach to emotional control can be seen throughout his career. He famously advises investors to be fearful when others are greedy and greedy when others are fearful, encouraging them to act rationally when emotions run high. But it goes deeper than that. Buffett's success can also be attributed to his ability to remain calm and focused during periods of market turbulence, when most people are acting on fear or making impulsive decisions. A perfect example of Buffett's emotional control is how he handled the 2008 financial crisis. While many investors were frantically selling off stocks in panic, Buffett remained calm and resolute in his approach. He saw the crisis as an opportunity to buy high-quality businesses at a discount, knowing that these companies would eventually recover and grow in value over time. His emotional detachment from the market's short-term swings allowed him to make calm, rational decisions while others were letting fear dictate their actions. During the crisis, Buffett made several bold investments, including purchasing significant stakes in companies like Goldman Sachs and General Electric. At a time when everyone was selling, he was buying. He didn't let the fear of the unknown cloud his judgment. Instead, he focused on the intrinsic value of the companies he was investing in, knowing that their strong fundamentals would prevail in the long run. Buffett's ability to stay level-headed during this time, while others were emotionally reacting to the market's volatility, demonstrated the power of emotional control in investing. To apply this to your own investing strategy, it's important to stay calm during market fluctuations and stick to your long-term plan. If your investments are in companies with strong fundamentals and solid growth potential, temporary market downturns should not cause panic. Instead, view them as opportunities to buy quality stocks at a lower price, just as Buffett did during the 2008 crisis. If you're emotionally detached and not swayed by the noise of the market, you'll be in a better position to make sound decisions that will help grow your wealth. In summary, the key takeaway from Buffett's strategy is that investing is a mental game. Emotional control is critical, especially during periods of market volatility. By staying calm and sticking to your long-term strategy, you can avoid impulsive decisions that might harm your portfolio. Like Buffett, the more you master your emotions, the more successful you'll be as an investor. Secret number 8. Build a strong network of advisors. One of Warren Buffett's most powerful pieces of advice is to surround yourself with trusted mentors and advisors. Buffett has always acknowledged that no one achieves success alone. While he is undeniably brilliant, much of his success has been driven by the strength of his relationships and his ability to learn from those around him. In Buffett's words, the best investment you can make is in your network and yourself. This insight highlights the importance of learning from others, building relationships with those who can provide valuable knowledge, and constantly improving yourself. The idea behind this is simple. No one has all the answers, and the most successful investors are those who know how to leverage the wisdom and experience of others. By surrounding yourself with people who have walked the path before you, you gain access to invaluable guidance, perspectives, and strategies that can accelerate your learning and help you avoid costly mistakes. Buffett himself is a prime example of this principle in action. One of the key people who has shaped his investment decisions and contributed to his success is his longtime business partner, Charlie Munger. Munger and Buffett have worked together for decades, and their partnership has been one of the most successful in the history of investing. Munger brings a unique perspective to Buffett's decision-making process, and their complementary skills and philosophies have been instrumental in the growth of Berkshire Hathaway. Buffett has often praised Munger for his ability to think clearly, avoid distractions, and make decisions based on sound principles. In fact, Buffett has said that Munger has been a tremendous influence on his own approach to investing, encouraging him to focus on businesses with strong fundamentals and avoid short-term speculation. Munger's ability to think independently and challenge Buffett's ideas has helped refine Buffett's own investment strategies, and the two men share a mutual respect for each other's expertise. To apply this to your own journey, it's important to seek out mentors and advisors who have experience in areas where you might be less knowledgeable. Whether it's an experienced investor, a successful entrepreneur, or someone with deep industry knowledge, having access to wise counsel can be invaluable. Find people who can challenge your thinking, offer new perspectives, and help you grow as an investor and individual. Building a strong network isn't just about finding mentors, it's also about surrounding yourself with peers and individuals who can support your goals. A strong network provides a safety net, offering you the chance to learn from others' successes and failures, and giving you access to new opportunities and ideas. In summary, Warren Buffett's success is partially attributed to his ability to surround himself with a strong network of trusted mentors and advisors. By learning from others, seeking out individuals with complementary skills, and building meaningful relationships, you position yourself for greater success. Remember, investing in your network and in yourself can often be just as important as investing in stocks or businesses. Secret number 9. Keep learning and stay curious. One of the most important habits Warren Buffett credits for his success is his constant pursuit of knowledge. Buffett spends a significant portion of his day reading, and he has made lifelong learning a cornerstone of his life and career. In fact, Buffett himself has said, "The more you learn, the more you earn." This isn't just about accumulating knowledge for the sake of it. It's about continuously improving yourself and staying ahead of the curve. The investment world is constantly evolving. New technologies, industries, and global events all have an impact on the market. To be successful, you need to stay informed and continuously adapt to new information. Buffett's habit of reading allows him to keep up with the latest trends, identify opportunities, and make informed decisions. While other investors may focus on short-term market movements, Buffett is reading books, financial reports, and newspapers to understand the long-term forces at play in the economy. Buffett has made it clear that reading is a key part of his daily routine. He spends hours each day going through a vast amount of material, including annual reports, company filings, and various books on investing and business. By immersing himself in knowledge, Buffett is constantly honing his skills and broadening his understanding of different industries, businesses, and investment strategies. To apply this principle in your own life, it's essential to make reading and learning a daily habit. The more you read, the more you expose yourself to new ideas, and the better equipped you'll be to make informed decisions. Whether it's books on investing, business, economics, or even history, every piece of knowledge you gain can have a lasting impact on your success. It's important to remember that you don't need to be reading books for hours on end to benefit from this habit. Even if you can dedicate just 30 minutes a day to reading or learning something new, it can pay off significantly in the long run. Over time, this consistent effort will compound, just like the power of compound interest in investing, allowing you to stay ahead of the game and make better decisions. A prime example of Buffett's commitment to learning is how he reads hundreds of pages every day. He said that he spends about 80% of his day reading, and much of it is related to business and investing. This habit has not only shaped his investment decisions, but also helped him become one of the most knowledgeable investors in the world. By staying curious and constantly feeding his mind with information, Buffett has been able to make wise, informed choices, no matter what challenges the market presents. In summary, the key takeaway here is that continuous learning is a vital part of success. Warren Buffett's success is largely attributed to his commitment to learning and staying curious. By making reading and education a priority, you position yourself to adapt to new information, stay ahead of market trends, and make better investment decisions over time. Keep feeding your mind, and your knowledge will work for you, just as it has for Buffett. Secret number 10. Patience is key. One of Warren Buffett's most fundamental principles is that the stock market transfers wealth from the impatient to the patient. This simple but powerful statement captures the essence of Buffett's approach to investing. While many investors rush to make decisions and chase quick returns, Buffett's success is largely due to his ability to remain patient and let his investments grow over time. The key takeaway here is that patience is one of the most important factors for long-term investment success. Investing is not a get-rich-quick game. It requires discipline, the ability to stay focused on your long-term goals, and the patience to allow your investments to grow over time. In fact, many of Buffett's best investments took years, even decades, to fully realize their value. Buffett often says that the stock market is a great mechanism for transferring wealth from those who are impatient to those who are willing to wait. In the world of investing, impatience often leads to mistakes. Investors who chase short-term gains may sell stocks prematurely or make emotional decisions based on market fluctuations. Patience, on the other hand, allows you to hold on to your best investments long enough for them to realize their full potential. To apply this to your own investing strategy, resist the urge to make snap decisions or react to every short-term market movement. Instead, focus on investing in companies that have strong fundamentals and the potential to grow over the long term. Once you make your investment, give it time to grow. Trust in your research and stay the course, even when market volatility may tempt you to sell or make changes to your portfolio. A perfect example of Buffett's patience is his investment in Wells Fargo. Buffett's Berkshire Hathaway started buying shares in Wells Fargo in the early 1980s, when the stock was priced relatively low. Over the decades, Buffett held on to this investment, even as the bank faced challenges and the stock price fluctuated. While many investors may have sold during periods of uncertainty or when the stock wasn't performing well, Buffett stuck with Wells Fargo, confident in its long-term potential. Buffett's patience has paid off. Today, Wells Fargo is one of the largest and most successful banks in the United States, and Buffett's investment has grown exponentially. This long-term commitment to high-quality investments has been a hallmark of Buffett's strategy throughout his career. By staying patient and trusting in his investments, he was able to benefit from the company's growth over time. In summary, the key lesson here is that patience is crucial for success in investing. Don't rush to make decisions, and don't let short-term market fluctuations influence your strategy. Focus on the long-term potential of your investments and give them the time they need to grow. By practicing patience, you'll be in a much better position to build lasting wealth, just as Warren Buffett has done throughout his legendary career. Today, we've uncovered the 10 key investment secrets from Warren Buffett that can truly transform the way you grow your money in 2025. From focusing on long-term value and maintaining patience, to learning from mentors and keeping emotions in check, these principles are timeless. They're about building wealth with smart, consistent strategies and a long-term mindset. But now, I want to hear from you. What's the most valuable investment secret you're going to start using in 2025? Drop a comment below and let's chat about how you're planning to apply these strategies to your own financial journey. And if you've learned something new today, don't forget to hit the like button and share this video with someone who could benefit from these tips. If you want even more financial strategies, insights, and actionable tips, be sure to subscribe and hit the notification bell so you won't miss out on any of our upcoming videos. We're committed to bringing you the knowledge you need to achieve your financial goals and stay ahead of the curve. Thanks for being part of this community, and I look forward to continuing the conversation with all of you. Keep focused, stay patient, and remember, your financial success is just a few smart steps away.